The Federal Competition and Consumer Protection Commission's FCCPC new digital lending regulations are facing intense lobbying from telecom giants because the rules threaten their lucrative monopolistic micro-lending operations. One telecom operator has reportedly generated an estimated 5.6 trillion naira between 2019 and 2023 from Nigerian consumers, with billions quietly, flowing to the foreign firm. The new FCCPC framework mandates that all telecom lending partnerships must include at least one Nigerian-owned company and requires all players to register and report for transparency. The intent is not to punish innovation, but to democratize opportunity, level the playing field for local fintechs, and ensure Nigeria retains a fair share of the digital value created within its borders. The author urges the government to stand firm against corporate lobbying to protect the long-term viability of the Nigerian fintech ecosystem. And we have the author joining us now, a policy analyst, Ayodele Adio. It's great to have you in.
Thank you for having me. It's good to be here.
Yes. Tell us a bit more about this framework and what it exposes.
Well, the framework doesn't, as it were, expose anything. It just seeks to liberalize the digital lending space in Nigeria and to sort of cap the dominance of the major telcos operating in the space. So essentially, what it seeks to achieve is to create an environment where local fintech startups can participate in the airtime and data lending space and can also create value locally, not just in terms of job creation and wealth creation for the companies who play in the space, but even more importantly, to add tremendous value to the local economy. The bill or the regulation also, seeks to curb predatory lending practices that has been pervasive in the last couple of years, especially if you look at the fact that many of these, loan companies or loan sharks, as it were, hardly ever declare, their interest rates or charge ridiculous interest rates that are outrageous and, end up crippling the finances of people who seek out those opportunities. So essentially, the bill or the regulation is trying to, on the one hand, sanitize, the lending space, especially to deter the incursion of these predatory lenders. And secondly, to also create an environment where local fintech startups can participate, in the airtime and data lending space, and to obviously open up opportunities on both ends of the divide. That is, on the one side, to create value for companies who play in the space, and on the other hand, to create value for people who are seeking small and short-term loans on the side of the consumer.
Interesting. And there's an estimated 5.6 trillion naira earned from airtime data lending. How does this compare to the total capital raised by Nigerian-owned fintech startups in the same period, especially illustrating the scale of the value flight?
Well, it's incomparable. You haven't really created that much value locally, to be honest. And again, it goes back to the arguments I made in that article, which is there are two cardinal problems that I think that this regulation seeks to achieve, which is one, revenue flight, and the second, obviously, is data protection, because these telcos not only dominate this lending space, they also gatekeep the data that is being collected and generated and not being shared with the credit bureau in Nigeria. So what that means essentially is that millions of Nigerians who borrow, airtime credit and pay back do not have a credit history upon which they can build some sort of, a digital lending credibility that allows them access to greater financing, as they climb the social ladder. And unfortunately, what that also means is that you do not have enough data for fintech companies, for commercial institutions, for mortgage institutions to create financial products that are able to fit into that demography in society. And that's why you have a situation where hundreds of thousands of low-income people continue to fall prey to these loan sharks, because those are the only ways or means that they can access capital. But if you sanitize this space and allow data to be shared between these telcos and these financial, perhaps the credit bureau, you can have a situation where these financial companies can create better products that can suit the market. And, many of people in the low income ladder will have no need whatsoever, to patronize loan sharks. And on the second hand, the amount of revenue flight is outstanding. The entire monies are being made from Nigeria, from Nigerians, but it would appear that the revenue is taking offshore, to whether it's Dubai or to South Africa, and we hardly seem to benefit from that revenue locally. And so the insistence by this regulation by the FCCPC that it's not going to stop the telcos from partnering with the companies that they already have arrangements with now. It's only saying that you would have to also create opportunities for local fintech startups to be able to also provide some of these services, essentially capping the market share of many of these dominant players. And I believe that that would obviously, undoubtedly, open up the space for limitless opportunities for not just local fintech startups, but for the economy generally, by stimulating activities in the local economy.
And as you imagine, telcos are not particularly pleased. They argue that the new rules are going to disrupt operations. What is the actual cost of compliance with the new, regulation of registration and partnership mandates compared to the lost monopoly profits that they currently enjoy?
Well, the truth is, it's not surprising that the telcos are pushing back. And of course, they are lobbying against the implementation of this particular regulation. It's expected. But the truth is, their arguments fall flat against the overwhelming evidence that it is not going to stifle innovation. In actual sense, it's actually going to stimulate, innovation. And the evidence across the world suggests that these sorts of regulation creates opportunities for local fintechs to play in the space, which also lead to tremendous value for the local economy. For instance, if you take a study of what happened in India with the payments, where it was dominated by two dominant apps that controlled over 85% of the market share. What the regulator did in India at the time was to cap the market share at 30%, which obviously incentivized local tech startups, to encroach into the space, to create tremendous value, to create alternative products, that could serve the market in different other ways that the dominant players weren't serving at the time. And the evidence suggests that years after that, it's added tremendous value to the local economy. It's created more jobs because more fintechs had had the opportunity to play in that space. So in other words, the evidence is overwhelmingly on the side of the regulator, and it suggests that rather than disincentivize innovation, it is actually going to spur innovation and creativity. And the idea that they continue to resist this, obviously just is a bit protectionist of their dominant market position, what you would expect, from a typical business venture. But the truth is, the regulations are not going to stifle any innovation. And some of the points that they make, that there's a bit of duplicity in some of the provisions in that regulation, that some of the things have been taken care of by the CBN, by the NDIC, and things like that. I, for one, do not think that's a problem. At the very least, such duplicity can be reconciled and harmonized, but the spirit of the regulation must stand, because it's overwhelmingly in favor of the local economy and for local startups.
And speaking of the spirit of the regulation standing, it's a new regulation from the FCCPC. Does the FCCPC have the institutional capacity as well as the political backing required to enforce these new rules against powerful multinational corporations?
That's a brilliant question that you've just asked, and that's where I worry, whether they have the institutional capacity to not just push this regulation through, but to also withstand, the behemoth of the lobbying force that these telcos can bring to bear. Now, what we can do, or what we perhaps, in my own capacity and setting other people in the fintech or in the tech ecosystem have been doing, is to put pressure on the regulator, whether it's the Minister of the Digital Economy and Communications, whether it's the SA to the President on Communications, or whether it's the NCC, is to sort of put pressure on these regulators to ensure that, they find a middle ground in the passage of this regulation, that, while there are concerns on the side of the telcos, the overwhelming benefit of the implementation of this regulation will be tremendous on the side of the Nigerian people and the local economy. And we just have to put pressure on them to ensure that this regulation see the light of day. Unfortunately, you're already seeing that even in the National Assembly, there are already a bit of cold feet as to some members suggesting that the regulation should be halted. But I think that the more that they hear from Nigerians, the more that the media speaks to issues like this, the more the debate is being opened up. I believe that will also sort of inspire confidence in the FCCPC that they are doing the right thing, and will make them stay the course. But again, I think especially in the political environment, pressure is everything, and we must continue to pressure the regulators to ensure that they do the right thing, and should not just be constantly at the beck and call of the big telcos. Remember that earlier this year, they were the ones at the forefront of championing the increase in tariff earlier this year. And mind you, let me just add quickly that I was in support of the tariff increase earlier this year, because I'd argued at the time that after 10 years, and given the current market realities and the inflationary environment, telcos had the right, especially in the market economy, to raise prices. And I made the case in favor of the telcos at the time. But the argument I'm making now is that the NCC and the regulators, their job is not to run advocacy on the side of the telcos, as they did at the time that they wanted to raise tariff. Their job is to be on the side of the consumers, that the average consumer gets value for the offerings that these telcos give, and to ensure that the regulatory environment does two things, which is it allows private sector to thrive, and on the other side, it limits the power of the private sector to exploit the average Nigerian citizen. So on this scorecard, I would argue that, we need to put pressure on the regulator to ensure that they do their jobs.
And you're putting that onus on Nigerians. So what do Nigerians or consumers benefit from this new framework? What's in it for the consumer?
I mean, if you look at the data, the amount of people who have committed suicide because of the way these loan sharks have gone about retrieving their loans from many Nigerians, it's being alarming. They send all sorts of messages to your friends on Facebook, to family. They use all sorts of, abusive languages and derogatory way that robs off people of their dignity. Now, once this regulation stands, what it means is that local fintech organizations will be able to play in that ecosystem and will be able to design products that will create access to finance, especially small finance, for people in the lower end of the ladder. And they will no longer need to be exposed to these unscrupulous loan sharks who exploit them with outrageous interest rates and have all sort of these medieval Machiavellian collection practices that robs them of their dignity. And so for me, the most important thing that this regulation does is that the data upon which better policy can be made on the side of government, and obviously on the side of the competition in terms of financial products and other fintech startups, in terms of creating access to cheaper credit for the average Nigerian, I think it's unbelievably, it will be unbelievably rewarding, for the average Nigerian. So it's in our interest to ensure a competitive landscape where, better products will be designed and where these products will be able to impact the average Nigerian better.
Mm-hmm. Finally, before we tie this together, there's at least one Nigerian-owned company rule in this framework. And not to give anyone ideas, right? The foreign firms, they could create shell companies, as a front for compliance. How do you think the FCCPC can strictly define and monitor this, that this doesn't happen?
Well, you're already giving them the leg up by giving them very brilliant ideas. But, well, the truth is there's a chance that that can be done. But if it's a limited liability company, the shares will reveal all the detail, right? And even though you try to set up shell companies and play all the gimmicks that you want to play, the truth is the business will be registered in Nigeria. The value will be captured in Nigeria. You would have to hire an amount of Nigerians in your board. And, it will be very difficult, to achieve revenue flight with those kinds of setups and arrangements. So while there's a chance that it can also be exploited, that there is a lacuna that, they could exploit from, the truth is it will be much more difficult to do. And whatever way they try to do it, much of the value will still be captured within our borders and within our economy. So I do not worry so much about that. But I also believe that once that space opens up, you would see a lot more local fintech startups who are more vocal, who have developed capacity, that'll be willing to play in that space. And will they themselves, not allow these shell companies to also edge them off the market?
All right. Thank you very much for your thoughts and insights. Policy analyst Ayodele Adio.